Ever wonder what really goes on behind the scenes when a major company, announces its quarterly results? It's way more than just a list of numbers, right? It's a compelling window into their strategy, how they're handling market conditions, and their vision for the future. Today, we're doing a deep dive into the latest financial disclosures from MAS Financial Services Ltd. This is for the quarter ending June 30th, 2025. We've got the full stack of their official documents here, board meeting outcomes, the detailed financial statements, investor decks, and even insights from their recent earnings call. Our mission, simple: to unpack all this information, pull out the most important nuggets, and give you a clear, informed picture, quickly and thoroughly.
Yeah, what's really fascinating here is how these reports, which can seem a bit dry, don't just show financial health.
Yeah.
They really lay bare the strategic DNA of the company, especially one in a sector as dynamic as financial services. We're going to connect the dots, from their latest board decisions right through to the performance figures and show how they're positioning themselves in the wider economic landscape.
Okay, so what does this all actually mean for you? Whether you track the market, study business, or you're just curious about how companies like MAS manage to thrive over time. Let's unpack this. Right, let's kick things off with the big picture, the headline numbers. What were the real standouts for MAS Financial Services this past quarter, both for the company itself and consolidated?
Okay, so on a consolidated basis, that's the company plus its subsidiaries. MAS Financial Services reported assets under management, AUM, of 13,298.50 crores. That's for the quarter ended June 30, 2025. Now, that represents pretty strong year-on-year growth, 20.82% compared to about 11,006 crores in Q1 of FY25. And profit after tax, PT, also on that consolidated basis, saw really robust growth. It hit 85.59 crores. That's up 19.34% from the 72.56 crores in the same quarter last year.
And focusing just on the main company, what about the standalone performance figures? What do they tell us?
Well, the standalone AUM was 12,504.60 crores. Growth there was very similar, 20.43% year-on-year. Standalone PT came in at 83.90 crores. Again, a solid increase, 19.13% from the previous year's corresponding quarter.
That's really consistent growth and mirroring pretty closely between consolidated and standalone. Impressive. I also heard this quarter marks a pretty big milestone for them historically.
Absolutely, yeah. The company just celebrated 30 years of operation. That was on May 25, 2025. And management didn't just, mention the date. They really highlighted it as a testament to their resilience and consistency, and about having built a strong foundation that can withstand the economic cycles you inevitably get in lending. This kind of longevity, plus consistent performance over 121 quarters, that's a key takeaway. It points to a successful model and solid risk management.
Okay, with those strong top line numbers, the obvious question is how? How are they getting this growth, especially when, things might be tighter elsewhere? Let's dive into the specific growth drivers. What kinds of loans are they really focusing on?
Right. Their core strategy seems pretty clear. They prioritize, and I quote, quality of the portfolio and profitability, while aiming for that sustained 20-25% growth. Their main focus, it really remains the MSME segment, micro, small, and medium enterprises. That consistently makes up about 75% of their total assets. This includes microenterprise loans, MLL, for amounts under 10 lakhs, and then SME loans, which range from 10 lakhs up to 5 crores. And what's really key this quarter is that the MSME segment alone contributed roughly 60% to their total year-on-year AUM growth.
60%. So it's definitely not just about the overall volume, but which types of lending are really powering things. What about the other segments? What else is contributing significantly, and how does it fit into that bigger picture?
Well, beyond MSME, the other 25% comes from their two-wheeler loans, 2W, and salaried personal loans, or SPL. Now, the SPL segment, that's relatively new for them. It showed, honestly, remarkable growth, individually 91% year-on-year, reaching 1,131 crores. But, and this is where their strategy comes in, it still makes up less than 10% of their total AUM. And that's not by chance. It seems like a deliberate plan to tap into that high-growth area, but without letting it, dilute their core MSME focus. It's a calculated way to diversify, I think, without losing sight of where their main strength lies.
Yeah, that makes sense. And that line about creating successful entrepreneurs, not just borrowers, that really speaks to something deeper, doesn't it? But as we always say in lending, even the best mission needs, rock solid financial health underneath. So let's turn from the vision to the execution. How healthy is their loan book right now?
Yet, despite the economic headwinds we've seen, they have maintained strong asset quality. It seems quite robust. Their net stage 3 assets, basically net NPAs after provisions, stood at 1.63% standalone. Gross Stage 3 was 2.49% as of June 30th. That gap between gross and net, it shows a healthy provisioning buffer. They've set aside quite a bit for potential losses, which is, prudent.
Right, prudent is the word. And they also carry that management overlay, don't they? 17.60 crore standalone, plus more for the housing subsidiary. That's not just standard provisioning, it's an extra buffer, voluntarily set aside. Shows a really cautious approach to maybe future bumps in the road. It sort of insulates the balance sheet. Now, this is where it gets really interesting for me. How are they seeing the economy right now, like on the ground, and what are they doing about it?
Well, management noted a slight improvement in ground conditions over the last 3 months, though they were careful to say it's not yet cognizable. But the key thing they observed, and frankly it's probably a relief, is that the deterioration has stopped. Things aren't getting worse. They seem to think it might take maybe a quarter or two for a more significant pickup in eligible demand. And they gave some specifics too, like textile is stabilizing, but FMCG is yet to stabilize. So it's a nuanced picture, cautious optimism perhaps.
Cautious optimism, I like that. Given that careful view, were there any recent regulatory changes, maybe from the RBI, that affected their risk management or how they operate?
Yes, definitely. Specifically around the RBI's draft guidelines on co-lending and fintech partnerships. The company actually views these quite positively. They said it brings a lot of clarity to the industry. And interestingly, MAS Financial Services stated they were already following similar norms. They mentioned ECL-based and profitability-neutral models even before the guidelines came out. So it sounds like they were kind of ahead of the curve there on risk practices. They also mentioned a recent operational shift in co-lending reporting. Now, the entire cash flow gets booked by MAS first, then distributed. Apparently, it's profitability neutral, but it gives them better control on the partners and aligns reporting more closely with how they actually do business.
That's a good position to be in, already aligned. Okay, but how are they actually funding all this growth and keeping things stable financially?
They seem very well capitalized and well funded. That's the term they used. As of June 30th, their capital adequacy ratio, CRAR, was really strong at 25.22%. That's well above the regulatory minimum of 15%, right? With TRI Capital at 23.19%. Their debt equity ratio was 3.36 times. That might sound a bit high initially.
Yeah, 3.36.
But for an MBFC like MAS, you have to consider their strategy. They aim to keep 20-25% of their AUM off book. They do this through direct assignment and co-lending. And that off-book piece is matching in tenor and without recourse. So it effectively balances out the leverage, letting them use debt efficiently for growth without taking on undue risk. It's quite strategic.
Right, that makes sense in context. And what about the cost of that debt? The cost of borrowing? Given recent interest rate movements, are they seeing any benefit?
Yeah, the cost of borrowing for Q1 FY26 was 9.80%. But crucially, with the recent repo rate cuts by the central bank, they anticipate a reduction. They're forecasting about 25-35 basis points lower borrowing costs during this year, starting possibly this quarter. That's because most of their borrowings are MCR-linked, tied to the bank's marginal cost of funds. So as market rates drop, their costs should follow, maybe with a bit of a lag, but it's a significant potential benefit to their bottom line down the road.
It's easy to get caught up in the numbers, isn't it? But behind it all, there are people, processes. How is MAS evolving its operations, its reach in the market?
Well, there's a pretty significant strategic shift happening or planned in their distribution channels. Right now, they get about 65-66% of their business from their own 206 direct retail branches. The rest comes from MBFC partnerships they've had for like 12 years. But the stated goal is to increase that direct retail share to 70-75%. And they plan to do that over the next 6 to 12 quarters.
Okay, so a definite move towards more direct business.
Exactly. It looks like a move to deepen customer relationships, maybe cut out intermediaries, capture more margin directly. It suggests a mature player optimizing its model. And they plan to do this by penetrating deeper in existing areas, west, north, south, before looking at new markets.
That sounds like leaning more heavily on their own infrastructure, their own direct engagement. How is technology helping with that shift? And just boosting efficiency overall?
Technology is seen as very important, naturally. They have a strong in-house tech team. And their loan origination system, the LOS, is now BRE enabled. That stands for Business Rule Engine enabled. The idea is to improve efficiency and profitability by automating more of the decision-making. Makes sense. They also use a lot of APIs for, seamless operations, from getting leads right through to digital disbursement and collections. It sounds quite modern, quite streamlined.
And the people side, the team making it all happen.
They highlighted a very strong HR team. And crucially, very low attrition, especially at middle and top management levels. They even shared a statistic. Over 600 people have been with the company for more than 3 years. Management called this a testimony to the fact that we have robust HR policies and our policy of succeeding and failing together. So it points to a stable, strong company culture, which likely helps retain talent.
Okay, let's shift focus slightly. Tell us about their housing finance arm, MAS Rural Housing and Mortgage Finance Limited. How's that subsidiary doing in its niche?
Right. In our HMFL, it focuses specifically on affordable housing finance, a really critical area, actually. It reported an AUM of 793.90 crores for the quarter. That's showing strong growth too, 27.46% year-on-year. Its PAT, profit after tax, grew almost identically, 27.04%, reaching 2.76 crores. And asset quality looks excellent there as well. Gross stage 3 at just near 0.92%, net stage 3 at near 0.64%. Very healthy for that segment. They sound quite optimistic too. They're confident to touch 1,000 crores this year in AUM for the subsidiary. That'd be a big milestone.
Beyond all these impressive numbers and operational details, what's the sort of the guiding philosophy, the vision driving MAS Financial Services? What identity are they projecting?
Well, they recently refreshed their identity. The new tagline is purpose-led, progress-driven. It's meant to capture their commitment to, well, purpose, progress, and people. Builds on their older mission of excellence through endeavors and financial inclusion. So reinforcing those core values. And they've gotten some notable recognitions too. The Financial Express CFO Awards back in May 2025, and also specific recognition from the National Housing Bank, NHB, for MRHMFL's work in housing finance for the EWS and alike segments. That's the economically weaker section and low-income groups. So real impact in underserved areas.
And looking further out, what are their long-term goals, especially now they've hit that 30-year mark?
The chairman and MD laid out some very ambitious targets. It really shows their belief in accelerating growth. Now they have this strong base. Get this. They aim to reach the next 13,000 crores in AUM within just the next 3 years.
Wow, 3 years after taking 30 for the first 13,000.
Exactly. It's a huge acceleration. And furthermore, they plan to add the next 2,700 crores to their net worth within 5 to 6 years. It really highlights their conviction and their growth potential now.
Yeah.
And alongside that, they continue to focus on ESG initiatives, strong corporate governance, the whole package for long-term value.
Okay, we have definitely covered a lot of ground in this deep dive into MAS Financial Services Q1 FY26 results. From that remarkably consistent financial performance and the strategic shifts in distribution to their clear commitment to asset quality and using technology, it really seems they're focused on sustained, purposeful growth.
Absolutely. That emphasis on consistent performance over decades, even through tough times, is really telling, isn't it? And their detailed strategic outlook, it gives valuable insight into how a company can not just navigate the current market, but actually set a strong path for future, even accelerated expansion.
So as we wrap up, what really stands out to you from this deep dive? Maybe it's that idea of balancing ambitious growth with that deeply ingrained risk management, or perhaps how a company deliberately chooses to serve specific segments like MSMEs for the long haul. Whatever it is, here's something to think about. In today's fast-changing financial world, how might MAS Financial Services' disciplined, purpose-led approach providing credit where it is due in these often underserved segments, how might that not only drive their own success, but maybe contribute to a more inclusive, more robust economic future for everyone?